Foreign exchange reserves, commonly referred to as foreign reserves, are assets held by a country's central bank in various foreign currencies. These reserves play a critical role in ensuring the financial stability and economic health of a nation. Central banks accumulate foreign reserves primarily in major currencies like the US dollar, euro, British pound, Japanese yen, and others. These reserves include not only foreign currency but also gold, special drawing rights, and reserve positions in the International Monetary Fund. The purpose of holding these reserves can be summarized in several key functions, which highlight their importance in both macroeconomic management and international financial relations. One of the main reasons central banks hold foreign reserves is to stabilize the value of their national currency. In the global market, currency exchange rates fluctuate due to various factors, including supply and demand, geopolitical events, and economic conditions. A volatile exchange rate can create uncertainty, impact trade, and affect investor confidence. If a country's currency depreciates significantly, its central bank can use its foreign reserves to purchase the national currency in the foreign exchange market, thus stabilizing its value. Conversely, if a currency appreciates too rapidly, the central bank can sell its reserves to temper the appreciation. This intervention helps maintain a more stable currency, which is essential for predictable trade and investment. Foreign reserves are essential for facilitating and promoting international trade. Since global trade is often conducted in widely accepted currencies like the US dollar or the euro, countries need foreign reserves to engage in these transactions. A country must pay for imports in foreign currency, and if it lacks sufficient reserves, it may face challenges in purchasing necessary goods and services from abroad. For example, many countries import energy resources like oil, which are priced in dollars. By maintaining a stockpile of foreign currencies, central banks ensure that their country can meet its import needs, especially in times of crisis or global market volatility. Foreign reserves also act as a safeguard against financial crises. Countries that have large reserves are viewed by investors and the international community as being more financially stable. A country with adequate reserves can easily meet its international obligations, such as repaying foreign debt, which increases investor confidence and reduces the likelihood of capital flight. In times of economic or political uncertainty, having substantial foreign reserves provides a cushion that allows the central bank to respond effectively to shocks. Countries with low reserves may find themselves vulnerable to speculative attacks on their currency or unable to borrow from international markets during crises, which can lead to inflation, debt defaults, or banking crises. The balance of payments is a statement that summarizes a country's transactions with the rest of the world. It includes the trade balance, capital flows, and financial transfers. If a country runs a deficit in its balance of payments, meaning it imports more than it exports, it must finance this deficit with foreign currency. Central banks use foreign reserves to manage these imbalances, ensuring that payments can be made even when there is a shortfall in trade or capital inflows. In the short term, reserves help smooth out fluctuations in the balance of payments, preventing disruptions in a country's ability to meet its international obligations. This stability is crucial for maintaining investor and market confidence, as it shows that a country can meet its external financial needs. Foreign reserves can also serve as an important tool for implementing monetary policy. Central banks use reserves to control money supply and influence interest rates. For example, if a central bank needs to reduce the supply of money to curb inflation, it can sell foreign reserves, which takes domestic currency out of circulation. Conversely, if a country needs to stimulate economic activity, it can purchase foreign reserves, increasing the money supply. Additionally, foreign reserves give central banks the ability to influence the exchange rate, which is a critical factor in controlling inflation. A stable currency ensures that inflationary pressures from imported goods do not destabilize the domestic economy. Foreign reserves can serve as a buffer against potential external threats or economic sanctions. In times of geopolitical tensions or trade disputes, access to foreign reserves can help a country sustain its economy even when faced with embargoes or sanctions. For instance, countries under economic sanctions may find it difficult to access global financial markets, but with sufficient reserves, they can continue to engage in necessary trade and support their currency. By holding reserves in multiple foreign currencies, central banks diversify their risk. If one currency depreciates due to economic or political instability, the value of reserves held in other currencies can offset the loss. This diversification helps maintain the overall value of a country's reserves and provides flexibility in managing foreign exchange operations. For some nations, having large foreign reserves is also a matter of international prestige and economic influence. Countries like China, which holds the largest foreign reserves in the world, use these reserves not only for domestic purposes but also as leverage in international financial diplomacy. By holding significant amounts of U.S. Treasury bonds, for example, China wields influence over U.S. economic policy. In summary, foreign reserves are a vital component of a country's financial system, offering stability, security, and flexibility in the face of global economic challenges. They allow countries to stabilize their currencies, support trade, manage balance of payments, and provide a buffer against crises. By maintaining these reserves, central banks help ensure that their country can weather financial storms, maintain investor confidence, and continue to engage in the global economy on favorable terms. The accumulation and effective management of foreign reserves are thus integral to a nation's economic health and sovereignty.